to REI Talk. Thank you for joining us, and welcome to our bi-weekly investment webinar brought to you by Real Estate Investor. Today's webinar is sponsored by Flight Property, and this is part one in a two-part 12J investment series. Part two of the 12J series will be on Tuesday, the 15th of June at 12 o'clock. So for those of you who don't know me, my name's Neil Peterson. I'm the founder and editor-in-chief of Real Estate Investor, and we've been serving the South African residential and commercial real estate industry for over 14 years now through our digital magazine, our online content, live and virtual events, webinars, masterclasses, videos, and podcasts. And we keep the investor up to date with the latest inside investor information, education, investment opportunities, and innovations. And that's for newbies, savvy property investors, home buyers, landlords, developers, and for you, the property professional and practitioners in the industry as well. So I'm really excited, and I'm honored to be your host and moderator for this webinar today. And our topic for today is quite a very interesting one. It's a very hot topic, and it is how to invest into 12J investment projects and take advantage of the 30th of June 2021 deadline. Yes, that's right. That's just around the corner, guys. You saw the clock count down right at the start of the webinar. And this is a massive opportunity, never to be repeated, never ever again. This is the final season, guys. Without further ado, I'm going to introduce you to our two guests today. We've first got Zane de Decker. He's the Chief Investment Officer for Anuva Investments and the Managing Director of Flight Property. And just a little bit about Zane. He's Flight Property Investment is the brainchild of Zane, and he started the company in 2017 after completing the successful merger of Preventers Property, his prior venture with a new partner. He has vast technical and practical knowledge in property. He's specifically in the asset and development management sector with 15 years experience in that field. He has a postgraduate degree in property studies from UCT, graduated cum laude, began his career working for several high worth property portfolios, including at Old Mutual and the Public Investment Corporation, PIC. In his position as property asset manager at the PIC, he oversaw several large projects and portfolio acquisitions, and was also involved in the V&A waterfront acquisition as well. So under Zane's leadership, Flight's mandate is to seek and execute investment opportunities that not only create wealth for shareholders, but contribute positively to the built environment landscape of the Cape. Zane, it's great having you on board, and welcome.
Yeah, thank you, Neil. Thanks for that nice introduction. And good to be on the show today.
Wonderful. Great. And then, of course, our second guest is Ryan Flowers. And Ryan is the asset manager of Flight Property Investment. And Ryan joined the Flight team in 2019 when the opportunity arose to join the team with Zane, who was a former colleague on this exciting new venture. And having been involved in the field of just shy a decade, Ryan has a keen passion and skill for property and asset management, and he's got a postgraduate degree with distinction in property studies, also from UCT, and he also entered the property space working at Preventers Property as an asset manager in 2013. And his invaluable experience gained to lead him filling the role of lead asset management of the VHON Properties portfolio in 2015, a multi-sectoral national portfolio and development company. And he's also served as a board member at several large residential developments, as well as heading up the management of the property management division. Ryan, it's great having you on the show.
How's it going, Neil? Thanks so much for having us. And yeah,
awesome. Great.
Good introduction.
Fantastic. It's great, actually. I mean, I'm so excited about this 12J investment. I think this is an opportunity that just, it presents itself once in a lifetime. And so, Zane, let's start off with you. Who are the people behind 12J? And tell us about Anuva Investments. How does it fit in with Flight Property? And why did Flight, who's essentially a property developer, want to get involved with 12J?
Sure, thanks, Neil. Well, I mean, if I really were to answer the question, who's behind 12J? Well, that would be SARS and National Government and Treasury. So I'll start there very quickly, just around the 12J incentive was put out by government. So it is a sort of rubber stamped, or in fact written by the powers that be. And it's an incentive to stimulate the economy. So at its heart or at its core, it's an incentive written into the Income Tax Act that allows investors a significant tax benefit if they make a qualifying investment. So we won't go too much in those details just yet, but what we recognized as Flight was an opportunity to package our projects that are compliant with the 12J legislation. Not all of them are, but many of them are. So we take those projects that are compliant, and we're able to, we recognized 3 years ago that there was quite an opportunity to, instead of selling a sectional title unit directly to an investor, if that particular unit was compliant, we could instead channel that investor's capital via a approved 12J company, or VCC as they're called, and then let the VCC make the investment. So it's a fairly simple structure, and Ryan will go into that detail a little bit later in the presentation. And at the time, Flight looked at the market to effectively partner with the best out there, and Anuva is the best in terms of the operators in the market. There are a number of 12J companies, and we did our homework and we partnered up with Anuva. Neil Hobbs and his team are certainly the thought leaders and the authorities of the, Neil serves on the 12J Council. He's consulted with SARS initially in terms of the actual formation of the legislation. So they're very much the forerunners in the space. Not necessarily the biggest fund, but certainly bespoke management and the right guys for us to partner with. So we formed a joint venture between Flight and Anuva, where, simply put, Flight does the property stuff. We fund the projects, we facilitate the investments and the management of those projects, and we supply the stock to the market, and we do the sales around that. And Anuva does the 12J stuff, so the fund management, all the compliance, regulations, SARS registrations, etc. So we each play to our strengths, and the partnership was formed almost 3 years ago now. But the first year end was February 2020. Last year, the first tax year, we did quite well in that year, and then we built out the team through COVID. We actually expanded quite rapidly, in fact, leading up to February this last year. And we were all hoping for an extension of the incentive, but unfortunately SARS and Treasury decided not to extend the incentive, which means that now June, end of next month, is the final opportunity. So the people behind Anuva is Neil Hobbs and his team. Anuva's got a fantastic board and leadership within Anuva. If you look at their website and the people behind Anuva, there are some seriously qualified and seriously experienced business people in Anuva that are running that company. And that gives us comfort that the investors coming into our projects are well looked after. And then from Flight's perspective, as I mentioned, we focus on the property, so we do what we do best.
And I know you're going to take us a little bit later. There you've got the 34 days left. And because maybe you can explain, this could be a massive opportunity if you've got a little bit of a tax problem, which a lot of people do have.
I think if it weren't for COVID and the pandemic and SARS's short-term cash crisis, they probably would have extended the incentive. And I must say, I feel sorry for SARS and the Treasury, because they need to balance short-term cash that they need versus long-term gains. And the concept behind 12J is to allow an investor to effectively keep their tax if they invest into the economy. So that's a great medium to long-term play, where they're actually growing the tax base in general, growing the economy, but they're foregoing the short term. So, as I mentioned, obviously not extending that, which means that the final opportunity is now. But they obviously were faced with quite a decision to make in the last budget speech, and so I just wanted to touch back to your question, who Anuva is, and from an Anuva's perspective, I serve on the board of Anuva as well, and act as the chief investment officer for Anuva. Anuva effectively has three focus areas. They've got an equity fund, which was the original, let's call it the original Anuva. So dating back to 2015, Anuva was established as an equity fund. A number of Neil Hobbs' clients, and from a tax perspective, have invested in that fund, and that's grown up to about 150 million worth as of today. The property fund, that's the portion that we're focusing on today, which is in essence a joint venture with our company Flight. That started February last year, as we had explained earlier. And Nuva also has a fixed income fund, which basically offers it's an asset rental business which offers investors a fixed deal. So Nuva is a 12J specialist. It's what they do. They are very much the thought leaders and the authority in that space. And through these three funds, they've got different managers and different partners managing them. But in our participation is in the property sector. And just roughly speaking, there's just on 1.1 billion of assets under management in Nuva, of which 58% of that total, so 583 million of the 1.1 is into our property projects. So we've got some numbers on the board, and those, all of that money is deployed. It's all sitting in various projects, effectively countrywide, and offering investors the return plus the tax break that they came in on.
Okay, so maybe just can elaborate then on on the 12J, because there are some people that know what Section 12J is. There's others that don't, but it's always a good starting point to explain that. But I think before we speak about the 12J, let's understand how income tax works. I mean, and I know you've got a wonderful slide to demonstrate that you earn more, you pay more, and what how does it actually work in practice? And I think there will be a lot of questions around that.
Sure. Okay. Well, I mean, fortunately or unfortunately, depending on which way you look at it, the more you earn, the more you pay. So this slide demonstrates that. So we have a progressive tax system here in South Africa. So if you earn a little bit, you only pay a little bit, and as you earn more, you pay more. So from about 1.6 million rands and upwards, anything over that figure, you're paying at the max rate of currently 45%. And up to that point, you're paying at a tiered bracket. So this graph just demonstrates that. So most of our clients, in fact, in any client, no matter how much you earn, whatever you invest is deductible. So you will get a benefit no matter how much you earn. But realistically speaking, from about R1 million and upwards, so if you're earning R1 million, you're paying just over 300,000 of the million is your tax base. So you're earning 1 million, you're paying about 300,000. Therefore, if you invest 1 million, you will get a refund of 300,000 rands, and then upwards from there. So if you're earning over 4 million, the full 2.5 million that you are eligible to invest sits in the 45% bracket. So if you're earning 4 million or more, you invest, for example, 1 million, your tax refund will literally be 450,000 rand of that million. So that just obviously the more you're paying in tax, the more 12J works for you, because that means your refund is more. Not to say that it doesn't, obviously it's not attractive to lower earners as well. But Neil, your question was, how does 12J work in particular? So this slide demonstrates that. So in a nutshell, a taxpayer, and that's generally an individual, but it can also be a company or a trust. So it doesn't matter what type of entity, as long as you're a registered taxpayer. In our case, instead of buying the property directly or buying the asset directly, the investor will subscribe for shares into a Nuva. That's the 12J registered entity. Now, it's as simple as whatever your investment value is, that number gets deducted off your income for the year. So simply put, let's say I'm earning 1 million rand for the year, and I therefore pay tax on 1 million. If I put R1 million into any 12J entity, I'm now going to reduce the 1 million down to 0, and therefore I pay no tax. Now, most salary earners, the employer is deducting the tax from their salary. So the tax is sitting in SARS's hands anyway, because it has to be deducted each month. They now do their next tax return. They've effectively got 0 taxable income because they've made their deduction via the 12J entity, and SARS will give you a refund of that 300,000. So that's simply, you buy your shares, you get your deduction. The Nuva, the 12J entity, then takes that money and invests that into a qualifying company. So in our case, we have an SPV, which is the entity which would own the property itself. That would be the qualifying company in our scenario. And that company then makes the investment into the actual property itself. So you own shares in the VCC. The VCC owns shares in the underlying entity, which makes the investment. As the investment itself earns income and or capital growth, those returns sit in that entity and flow back to the investor as a dividend. So it's not a complicated scenario, but it is indirect property ownership in that you're owning shares in an entity, which in turn owns the underlying asset. But the structuring of this is fairly straightforward, and we obviously with Anuva and their team handle all of the actual compliance and structuring around that. So Neil, I hope that answers the question. But
yes, sure. No, it has. There are a couple of questions that have come through with related to that. I mean, some, quite a few people, and obviously your more sort of cynical ones would say that 12J doesn't save you tax, but simply delays it. What would you say to that kind of comment?
Well, I would say they're wrong, because it is incorrect. So 12J does save you tax. So what happens is, let's go back to my R1 million example. So if I make R1 million investment, I will get R1 million deduction off my income tax. So therefore I save the tax amount on R1 million. Now what happens is, if you sell your shares within 5 years, SARS has a full recoupment of that initial tax. So if you do sell in year 2 or 3 or whatever, yes, then you've just delayed your tax because you owe it back. But if you keep your shares for 5 years, then there's no recoupment. So you do save that money directly. If you sell your shares after 5 years, there would be a capital gains tax applicable. However, capital gains tax is always much less than income tax. So you will save that difference. However, and Ryan will touch on this a bit later, but in our mechanism, we actually avoid the capital gains tax as well. In other words, you'll exit Anuva, retain the underlying company with the property in it, and not pay capital gains tax. But Neil, there is some truth in that statement, and it's something that's not widely spoken or not widely publicized, and that is in 2014, 2015, around that time, there was a significant revamp of the 12J legislation. So initially in 2009, leading up to about 2014, at that point in time, it was at that time correct that if you made an investment, at any point in time, there was a full recoupment. So the rules changed a couple of years ago. So the people that did their homework on 12J initially would have at that time correctly concluded that it simply delays your tax. But that rule changed, and it now directly saves you, because I think SARS and Treasury, they realized that due to that, it wasn't attractive enough, because why would I make this investment simply just to delay my tax? I actually want to save tax. So they changed it, and there's no recoupment after 5 years. So some people that have that thought in their mind, they're probably referring to advice that they may have gotten pre-2015, which at that point was indeed correct.
Okay, great. So Ryan, we're going to get you this question that came through, and I think it's highly relevant in terms of where we are in the discussion now. And the question is the tax incentive the only reason to invest in a 12J entity? I think a pretty good question.
It's obviously not the only reason, because you always want to look at the underlying investment. You don't want to make an investment simply for the tax, because you need to understand what you're investing in. And I think, however, with the joint venture between Anuva and Flight, and how we run our investments, the investor always knows exactly what they are coming into. They will specifically choose a particular project, more so they would even choose a particular unit at a particular project. So I'm almost going to contradict myself here a little bit, because you could come along to one of our projects today. Let's take Tubbolt Square or like the East Side, for example. You are able to buy that unit directly and just own it, straightforward. Just no 12J, no structuring, nothing, no tax back. So let's say you like a unit for 1 million. Nothing stops you from buying that unit for 1 million. However, if you were to come in via Anuva, you get the same underlying investment and you get your tax back on that million. So to answer your question differently, in our structure, specifically for property, yes, you are actually only coming into Anuva to save the tax, but that's because you've already decided which underlying investment you want to make, and that investment is available 12J or no 12J. I mean, it's not up. In other words, our projects are priced at a market rate, and we are selling those units in the market, and we offer the investors the option of acquiring them traditionally, buy-to-let style, or via the 12J mechanism. So so that's sort of unique to our model, and what that affords or allows the investors to really have a good look at is really getting their minds around what the underlying investment is, what's the rate per square meter, what's the yield, etc. And then also being able to ring fence the cost of the 12-day structure to their tax benefit. And it's not all mixed together. You can quite clearly see, okay, well, our benefit is 45%, and it's costing me, for example, 8.5% over the full, which is what the cost is over the 5 years. So that math makes sense. And separately, that's the unit that I'm going to be buying. So that's been, I think, the success of our model, is to be able to actually clearly unpack those things. Whereas, if you look at some of the, potentially other 12J options, you don't really get that feeling of exactly what you're coming in for, or sort of how that would actually work.
Okay, it brings it to the next question, which I think you partly answered. But Zane, how does property qualify for the incentive, and how does Inuva decide what projects to tackle? And are these only flight projects? And I think flight focuses on on particular subsectors. You can maybe elaborate on that as well.
Sure. So, I mean, the irony of this, in a sense, is that property is actually an exclusion in terms of 12J. So property per se. In other words, a 12J company, Inuva or any other one, cannot simply buy property. It can't own a piece of land or a retail center or whatever, but it can own hospitality property. So there's a specific category of property that is specifically allowed, which is hospitality property. And under that definition, one can either invest in student accommodation, serviced apartments, or hotels. So those are the three areas that are allowed, and nothing else is allowed. So earlier when in the introduction, I said, flight's a property investment and development company. Not all of our projects qualify, but those that are student accommodation and or serviced apartments do qualify. And that's really our niche. So we focus predominantly within those spaces. We like to focus on projects that the ticket price is fairly low, sort of around 1 to 1.5 million a unit. That's where we see obviously the best returns, also good ability to raise bank funding, and a sectional title project. So if you want to exit your investment, a lot of people are a bit wary about owning shares in a company because how do you exit? But in this scenario, the exit is as simple as selling the property, because now you've liquidated your capital, then the entity, your shares can be repurchased back by the company. So your exit is no different to what it would have been had you owned that property directly, is what we've actually, So that's the, so to answer your question simply, it needs to be hospitality property, and then they're not necessarily all flight projects. So we've actually sold out of all of our own projects. We've had a couple of projects under our management, which are fully subscribed, and we now have joint ventured with a couple of property owner partners. One is Spear REIT Limited, the listed entity Spear, which we partnered with them on one project called Upper East Side in Woodstock, and we've also partnered with Steve Herring from Heriot REIT with their One Tubalt project. So those are not projects that we as Flight own, but we've joint ventured with them to provide our 12J solution and sales offering to the market on those projects.
Excellent. Great. Thanks, Zane. So Ryan, you've been very quiet in your corner, but I think we've got to tell us now what Flight has seen quite a lot of success. I mean, Zane touched on some of them over the last couple of years. As an asset manager, what would you put this down to? And can you give us an idea of the numbers from a property perspective? How many investors onboarded? How much investment have you accumulated? Because, I mean, it just gives so much credibility in terms of what you're offering.
Cool. Thanks, Neil. So I think, as Zane mentioned, the tax benefit and linking that with property is obviously going to be an incentive that you're basically slapping a massive 45% discount sticker on your property developments, which helps with sales. It certainly has helped us, especially during this pandemic. We actually haven't seen it slow down at all. And so, we've been super fortunate in that regard. But I think more so than that is call it the bespoke nature of what we've been able to do with particularly our Flight Select model, where an investor can actually go and choose that specific unit he wants. He's not coming into this, call it black hole of a property fund where he's one of 1,000 small investors. He's got full control over his unit, and we essentially re-engineered our model looking at it from an investor's perspective. We are selling stock to the market, to normal buy-to-let investors, and we kind of said, how can we get these investors into a position where they are largely unaffected in terms of the 12J structure, save for getting a tax benefit. And that was the starting point for us. And once we managed to kind of crack that properly, which I'll go through in a little bit more detail now, it really kind of unlocked things for us, because investors have the flexibility to choose that property that they want. They have ownership of that property, but they're still getting it at a significant discount. So that's the first thing. The second thing is more around the asset class itself, being property. As Zane mentioned, the incentive initially was put together with the purpose of growing small business and ultimately growing jobs and then the economy. And growing small business is typically high risk. So in order to get people to put their money into small business, SARS has to give a healthy incentive. But as you might know, small business can fold quite quickly, and we've seen that with the pandemic as well. Businesses can shut up really, really fast. And so investors coming into a typical 12J have that risk. But what we've been able to do is we've said, okay, we take this high risk incentive that SARS is giving us, effectively a 45% return on day one, essentially, on our investment, or de-risking it by 45%. And we're putting that into a stable asset class, an asset class that is backed by bricks and mortar. And if you even go back and have a look at how the property market tanked after the financial crisis, we didn't see that drop being anywhere near 45%, which means even if there was another market crash, our investors would still be sitting in the green. So that benefit of having a stable asset class is a huge one. The next, and I'm going to demonstrate this with a slide, if you don't mind, is yes, the beauty of leverage. And yeah, to some of the listeners here as well, it won't be new to them to use bank funding to fund a property purchase, but it does change significantly when you have SARS at the table.
Right. So
in a typical investment, an investor would need to bring money to the table. So let's just say we're looking at a 1.5 million rand investment. The investor would typically need 1.5 million in cash. Now, if we have SARS at the table, we know that at 45% tax bracket, he doesn't need to come up with the 1.5 million. He only needs to come up with the 825. So SARS is effectively putting down a deposit for him on that investment. What that means is that when we go to the bank for our funding, we don't need to ask the bank for the full 90% loan that you would need to typically if you don't have the cash. We only need a 50% home loan because SARS is effectively playing financier here as well, which means the investor really only needs a small deposit in order to get into this property investment. This obviously assumes that he's in the highest earning tax bracket. Now, on exit from the investment, the bank is always going to want their money back when you sell at the end of the 5-year period. But SARS is actually not going to want their money back. As Zane mentioned, that's for the benefit of the individual, which is massive. You would need, you're obviously going to cash out a lot more than you would typically would. And obviously the investor would get the initial deposit back, plus any growth and returns on the asset itself over the period. Now this has a significant impact on the return on investment. So if we targeted a typical 11% return per year, and that's made up of a 6% income return plus a 5% capital appreciation, and that's obviously an estimate, and those are the sort of numbers we typically look to target. This is a stable property asset, so we're not looking for unbelievable growth. But once we factor in that the bank is involved, that return obviously is leveraged up. The investor gets the benefit of that bank funding. But once we also calculate that SARS is at the table, that benefit goes through the roof, given that they're really only in for their, call it 5% deposit. Now, this would be the case as well if we were to look at a 90% loan, but that doesn't take into account the huge cash exit when you eventually sell the property. So that's obviously a key benefit in our structure as well. Other things to remember here is that there's going to be interest savings as well from a home loan point of view over the holding period. You're only paying interest on a 50% home loan, which means cash flow to the investor from the rental generated from the property is a lot closer to that break-even point, almost from day one. And some of our investors are in the green from day one without having to put much in themselves. And I think the last huge benefit to the Flight Select model is that we can help people whether or not they have cash to invest. So something Zane mentioned is that initial investment needs to go into Anuva. You're purchasing those shares in the venture capital company, which gives you your tax break. But a bank or a home loan provider is never going to be able to give you that cash initially to purchase those shares. The bank is always going to give you the money to purchase the property, which leaves us with a bit of a problem, and it's a timing problem. And the way that Flight solves that is that we actually have our own bridging finance company, which allows our investors to invest into Anuva, the Section 12J company, to facilitate that refund, and then we use that tax to go put down as a deposit on their investment, and the bank will then give them the home loan finance on the property asset itself. So we're unique in the market in providing that, specifically when it comes to purchasing specific units. In terms of the numbers, you asked for what we have on the board, so to speak.
Yep.
In the property fund itself, we've got close on 600 million invested. Those are across our 3 projects, which we've sold out of in February this year. We were quite successful in our raise, and that's why other developers have started approaching us, and which is why we've also engaged with the REITs to sell some of their developments for them, because the numbers don't lie. In terms of individual investors, close on 550 individuals, looking at a unit value of roughly 1.5 million. As Zane mentioned, you don't need to earn the 1.5 million to invest 1.5 million. What's important here is actually looking at the affordability of the individual to get their home loan. You can tick that box and you can afford to buy and invest in property. We can certainly help you out. And even if you don't have a home loan, we can also, or can't afford a home loan, we can certainly help you as well. But I hope that answers your question.
Yes, no, absolutely. So Zane has actually shared some of the projects already. He's mentioned them, but I think it'd probably be a good idea to put up what are some of the investment projects and structure options that we have available today, because I think that's really the crux of it. Where can people get this opportunity to invest in this 12-rate structure? Do you want to maybe take us through that, Ryan?
Yeah, sure. Let me just share again here.
And I know there's also 3 options, 3 investment options. So maybe you can take us from the projects and then right through into those, the Flight Select, Flight Partnership, and Flight Hospitality, which Zane also touched on a little bit earlier.
Yeah, sure. In the Flight Select model, I'll get to those details now. We have 2 options available this year. Those are the Upper East Side Hotel in Woodstock, which is a 183 unit hotel currently. It's managed by Hilton. They've got a management agreement there, and we've been able to structure our management agreement with them to include a 5-year rental guarantee. That guarantee is given by the REIT, Sphere REIT, as part of the the sale of the assets, and then Anuva are underpinning the other 2 years. And that's 7.5% net property yield. So that's quite attractive to anyone who's concerned about the hospitality market and is COVID here to stay, those sorts of things. Yeah. The units there range from 735,000 Rand right up to about 3.5 million for some of the bigger loft apartments. And you also get some benefits of purchasing at Upper East Side. You get to stay in the units for 7 days a year, which is quite handy for people coming down from upcountry. It's nice to be able to know that there's somewhere to stay. You won't necessarily stay in your specific unit, but you will get one that's similar. In terms of the finance there, Flight 12J, the bridging loan provider, can provide loans of up to 95% on those unit values. So if someone wants to invest before the end of June and make use of the tax benefits, then we can certainly help them out, and then we can arrange the bond finance a little bit later. 1 Tybalt Square, which is a project in town. You might notice the Standard Bank building. Yes. It's a residential redevelopment. So the top 15 floors of that building are going to be redeveloped into residential, and we're selling 5 of those floors in the current capital raise. Those units there range from micro apartments around 20 square meters up to 60 square meter 2 beds with uninterrupted mountain and harbour views. It's a great project, and we've seen good uptake already on those. There is a rental guarantee in place there. It's not a hotel operator that's running the whole scheme. There is an on-site management team, and there is a 6% rental guarantee for that first year as well. Because it's call it more of a traditional residential type development, there's a 10% deposit required on the units themselves, but we can also provide up to 90% bridging finance as well for the investor. Something to note there, all of these units are fully managed by an on-site operator, and they also all come fully furnished as part of our offering. So investors are paying the ticket price, but they don't actually have to pay for the furniture on top of that, which is obviously quite a big benefit. Just looking at a couple of pictures here, I've got them. This is the 1 Tybalt. Some of the views from the apartments. This project is still under construction, and it's going to be completed in about 18 months' time. So investors would come into the fund now. We still have quite a long time to finalize the home loans, and they would only take transfer on completion of the units. Some of the layouts there as well.
Great.
All this information is obviously on our website as well.
Great stuff. Do you want to take us through the different funds, Ryan?
Yeah, sure.
Just in terms of the structure, because I think that's quite important, and how that actually works in terms of the shares and that kind of stuff, and the holding, the select fund and the partnership fund.
Yeah, sure. So the select fund has been extremely popular for us. Let me just stop the share here. As I mentioned, an investor picks their own unit, and that unit goes into the management of the on-site manager. It's looked after, it's furnished, and for the 5-year period, the investor really doesn't have to think much about it. In terms of the structure of that investment, as they mentioned, Anuva as the fund cannot own the property directly, and so what we do is we actually set up a company for the investor. So I'll just show you the structure that quickly. It really is very simple. The investor invests into Anuva, which facilitates their tax refund. That tax refund then goes into this company, which we set for the investor. This company is a shelf company. It's a brand new company. It's got no trading history, and the investor is the only director in that company. So it's as if he owns it outright. There is a shareholding to Anuva for the first 5 years. The reason Anuva is at the table, so to speak, is because the fund needs to ensure that anything owned in this company qualifies in terms of Section 12J. So if we were to just set this company up with the investor holding 100% initially, we would have no control over what happens, and Anuva would be at risk for huge penalties to SARS if there's non-compliance. This company is going to go on to purchase the property. This is the unit that the investor has decided on. And if the investor requires a home loan and they're not paying cash for the unit, it would be this company that approaches the bank for that finance. That company is also going to sign the offer to purchase with the developer to purchase the property out. And it's on the back of the individual's affordability that they would get that home loan. So the bank is not going to look at Anuva and their balance sheet to approve the home loan. It would really be on the back of the individual's affordability. An investor can come into this company with partners as well. We've seen a lot of couples come in together into this company so that they can both use their own their joint affordability for a slightly bigger unit or multiple units. And so it's a very simple but quite an innovative structure actually. That's the holding period for 5 years, Neil. So investors would sit in this pattern for 5 years, paying off their home loan on a monthly basis, much the same as they would on any other buy-to-let investment. A debit order would go off their own bank account as it would normally. Quite importantly, though, after the 5 years, Anuva actually gives up its shares in that company, and those shares move across to the individual. And so in this picture, the 12J doesn't actually apply anymore. So after 5 years, the individual will have the freedom to use that property for whatever they like. It doesn't need to comply with the Act. They can sell that property. They can move it into it themselves. They're free to start a business in this company if they like as well. And as Zane mentioned earlier, this structure allows us to actually get away from that capital gains tax implication on exit from the 12J. Because this is effectively a swap of shares, it doesn't actually trigger capital gains tax, which means as long as the investor holds the shares in his company, he doesn't actually have to pay that capital gains tax back at all, which is huge. And that's how we are fundamentally different in our exit strategy. Okay, so that's how the select fund works. The partnership fund was kind of born out of the select fund, and as we were selling the select, naturally targeting your kind of higher earners who are paying more tax, we came across not such an obvious problem, and that is that just because someone makes a decent salary doesn't necessarily mean that they can or want to go and get an additional home loan for an investment property. They might have car repayments or a big house to pay off, or even school fees, those normal life cash flow issues. Yeah. But that doesn't mean that they don't have to pay tax. They're still being taxed at 45%. And it was with that in mind that we came up with the Flight Partnership Fund. And so what the Partnership Fund does is it's essentially the select fund, except there's two slight differences. One is that the individual doesn't actually pick his specific unit. He actually comes into a partnership with Flight and a whole lot of other investors, and we go and purchase a whole lot of units. The second is that we actually don't go to the bank and ask him to sign sureties for a home loan, because that's what he's trying to get away from. And that's why it's called the partnership, because Flight actually partners with the individuals in that company. So it's a 50-50 partnership, and Flight actually provides the finance required to bridge the gap between the individual's tax refund and the purchase price of the property. So what that means is that without actually needing to put down anything more than the tax you would have anyway paid to SARS, you can now get involved in a property investment alongside Flight as a partner. Then at the end of the 5-year period, you can then exit from that company. You can either sell your shares back to Flight or continue holding them, and obviously benefit from getting all of your tax back, essentially. During that 5-year period, there aren't any dividends in the partnership model. All of the income generated from the property goes towards settling that loan that Flight gave up front. But this has been a huge market for us. Our partnership fund is close on 200 million now, and it's because of the low barriers to entry. We're effectively saying that an individual just needs to commit his tax. And that's it. He either commits his tax before the end of June, and he puts it into a property investment, or he gives it to SARS. That's really, it's one of those two options. On the partnership model, we can also provide bridging finance, which means you don't need the 35% up front to invest. You can pay that in when your tax refund comes back. So yeah, it's an incredibly popular option as well.
Yeah, excellent. So Ryan, just a question around, if somebody wants to obviously take advantage, I think, is the 30th of June deadline, is that when the paperwork and deposits have to be paid? What is the process? What actually cuts off after the 30th? So if somebody wants to take, there's people listening here, they want to take advantage of this opportunity. Who do they contact? How do they go about it? Is it quite quick? If somebody had to come on the 29th or the day before and want to invest, is that still possible?
I'll tell you now, Neil, it is possible and it does happen. On the last weekend in February, the 27th and 28th, we had 70 million of investment come in. And it's surprising just how last minute people can be. But we would really urge people to use this month that we've got. We can certainly help you out right up until sort of mid-June. I would really not want to be pushed too late. The earlier the better. But in terms of sign up, it's quite straightforward. We need to just decide really, are you looking for a specific unit, or are you looking just to save your tax and put your tax towards a specific property? So you can get in touch with us either via our website or via emails to you. One of our investment consultants will give you a shot, run through the structure, and yeah, we can process those bridging loans as well very quickly. But what is fundamentally important is that if there's no proof of payment into Anuva before the end of June, whether it is the investor investing their own cash or the investor taking a 12J loan from us, they will not be able to get that tax back. That's what SARS is going to ask for. They need proof that that investment was made during that tax year.
Great. So guys, I want to handle some questions in closing. We've got about 10 minutes to go here, so I'm going to bounce between the two of you, Zane. A very important question is, there's also properties are locked in for 5 years. Does this mean that I can't live in it? And how does that management work?
Yeah, so it does mean that you can't live in it, because we have to remember, as we said earlier, the only type of property that qualifies is hospitality property. So we need to manage them in a compliant manner. So that means it needs to be a service apartment, so either short-term letting or medium and long-term, because remember, student accommodation is medium to long-term. So it doesn't necessarily mean it must be like daily rentals or weekly. A lot of our stock is monthly or even sort of 6-month rental, etc. But it has to be serviced and furnished, i.e., not a residential place. So you can't buy a unit and live in it. If you really like one of the projects, you're welcome to buy the unit directly outside of 12J and then live in it. Or alternatively, after the 5 years is up and you exit from Anuva, but keep the investment, you no longer then are part of the 12J structure, and therefore at that point you can then use it in any way you like.
Okay, perfect. Does this work for non-residents? I have a resident limited company though.
Yeah, so the quick answer is it works as long as you're a taxpayer. If you're a registered South African taxpayer, then yes, you can claim the deduction. So I'm not sure if that you can be a non-resident, as long as you're a taxpayer. So any entity, so any PTY Limited or South African Trust would be a taxpayer. So his local company would qualify.
Excellent. Another question from Ashraf. Will there be a VAT repay payable by an investor upon exit after the 5-year holding period?
So, okay, we can dig into a bit of detail on that question. So there's a couple of exits at play. So the one exit is that you exit from Anuva. So the answer to there is no, there's no VAT application. So you simply taken over all the shares in the underlying SPV and you're giving up your shares in Anuva. Now you own the SPV outright. The VAT implication that I think the person's asking about is that in the management agreement, there is the opportunity to claim the VAT back on the unit price, which is done, and that cash is then used to actually furnish the unit. So if that's the scenario, i.e. 12J buy the unit was purchased under our 12J structure, you then get the benefit of the cash flow from the VAT perspective. Some of that cash is given back to the investor. The balance that is used to furnish the unit, to buy the furniture. The flip side of that is that if that unit is then pulled out of that rental management agreement and converted to residential, then you would have to pay the VAT back. If the investor pulls it out of that agreement but keeps it as a commercial trade, then they could pay the VAT but also claim it back again, so it'll effectively be VAT neutral. So it actually goes towards the use after 5 years. If you're using it as residential, yes, you will incur a VAT liability.
Okay, right. A question for you. What would differentiate flight after 30th of June when the tax incentive 12J comes to an end? Interesting.
That's the question. I didn't ask that one.
Pass that one across.
You've got to repurpose your business.
I think going back to our roots, I mean, we are property developers in terms of our background. So what 12J has helped us do is it's helped us sell stock, which has been great, and it's helped us grow our business in a way that we previously didn't have the opportunity to do, and create jobs and create employment and save people a whole lot of tax at the same time. But that doesn't mean that property development stops after the 30th of June. There'll still be a need for that. And I think what we have on our side as well is that we now have a lot of investors who have seen what we've been able to do. They've seen the tax savings we've been able to give them and the service we've been able to provide. And we now have people who will look to us for the next opportunity as well. So we're looking forward to helping those investors, but at the same time, we're property developers and we'll continue to look for opportunities. We also have we're also fortunate in that we self-funded, so we don't rely too much on bank finance. So if a project makes sense to us, we're flexible enough to make it happen and to make it happen quite quickly.
Excellent. Okay, and here's a bit of a general question. I mean, I think you touched on it a little bit earlier on, Zane. It said, why is the scheme being closed down the end of June? I suppose we have to ask SARS, don't we? And I think you really sort of touched on it, I think, at the beginning. I don't want to comment on that, Zane.
No, I'd love to comment on that, Neil. I think the reality is, and we can all complain that it extended and this and that, but at the end of the day, it was an incentive. In other words, you've got your normal tax law, and then they said, well, here's a cherry on top. And an incentive must end. Otherwise, it's not an incentive. It's just the law. So, a lot of people don't realize that the 12J has actually been around for 12 years. So it was a 12-year-long incentive. Started 2009. Halfway through, as I mentioned earlier, it was quite a revamp. It became a lot more attractive in the later years. But nonetheless, it ran its full course of 12 years. And just because it kind of really started coming to its own towards the end, it's a bit of a pity that we didn't have a bit more runway on that. But, I suppose from SARS perspective and Treasury, they said, listen, there was 12 years, it's run its course. I forget there's that figure now, but it's probably upwards of 20 billion, maybe a bit more now. That's in 12J in total. I suppose it's just run its course, and they decided, and also I think that the pandemic, I suppose, has created a more acute flow scenario for the country. So I suppose a short-term cash flow for SARS and Treasury is possibly more important at this stage.
Absolutely. But I mean, the good news is we've still got until the 30th of June. So guys, you can jump in. Yeah. So don't miss this opportunity. Talk to Ryan, talk to Zane and their team. And what I'm going to do is just ask you, the two gents, just to wrap up. Ryan, just give us your final thoughts. If you want to give some couple of tips first, you, Ryan, and then Zane, and then we come to the end of our webinar. And for those of you, we will be sending recordings of this, and we will pass it on also to the flight team. So if there is technical information, like for example, people asking on interest rates on bridging finance and through flight, and what is my financial obligation? And I think those are very specific product questions which we can get to later. But certainly your wrap up and your final thoughts there, Ryan.
Yeah, sure. I mean, I think I'll just urge everyone, as I have with my family members and my friends who are in tax-paying positions, to really engage with this. The first thought is surely not. This can't be true. But we've had success. This is legislated. It's regulated. This is a SARS incentive. So I wouldn't shy away from it because it looks attractive. I would actually kind of move towards that. The second thing is it allows people, and I didn't touch too much on this, but regardless of your current tax position, so you might have gone through COVID and not earned that much this year. You might say, oh, I'm only paying X rand to SARS, it's not worth it. What the incentive affords you is it allows you to build up a tax loss which you can carry forward into future years where you are yet to earn income. So regardless of who you are, you have, as an individual, you have 2.5 million of taxable income that you can shield from tax. And it's creating that tax shield that is also attractive. And so provided you've got the affordability covered to purchase your investment property, there's no reason you shouldn't have a look at this. You're looking at a stable asset, and you're then shielding yourself from 2.5 million rands worth of income, which in itself is over 1 million rands of actual rands. So you essentially can walk away. You can walk away from 1 million rand at the end of this next month if you decide not to go ahead. So yeah, I mean, if that's not motivation, I'm really not sure what is.
Absolutely. I think a nice way of putting it there, Ryan. Thank you. Zane, sorry, we're just running a bit of time there, Ryan. Zane, do you want to give us your final wrap, your final thoughts? Thank you, Ryan.
Yeah, so unfortunately, Neil Hobbs, who's the CEO of Anuva, couldn't make this time slot today, but I'll echo what I've heard him say several occasions. And he's a very experienced tax practitioner. In his words, this is the best tax incentive you will ever see. It's the best that he's ever seen. It's by far the most attractive incentive that SARS has ever, there's nothing that comes close to this. We're packaging it from a flight's perspective into a specific property with a lend and this and that. So that, it's quite a structured product, but at the top line, there's nothing that's ever come close to this or likely to come close to this. And next month is your final opportunity ever. So I think, as Ryan said, engage with us, phone us. You can meet us at our office. You can talk to our guys. We're here and available to engage further. We'd love to kind of do that with anybody that's on the call, or just to engage with us on that. So we're looking forward to doing that and having a good June, of course. So, but I'll close out there. Thanks, Neil.
Wonderful. Thank you, Zane. Zane de Decker, he's the Chief Investment Officer of Anuva. And Zane, we hope to also get Neil Hobbs on, I think, on the next webinar that we got on Tuesday, the 15th. So there's still another one. So we're hoping to get him on that one. It's going to be from 12 o'clock to 1 o'clock as a follow-up. And then to you, Ryan Flowers, the asset manager of Flight Property, thank you for joining us. And to you, the audience, thank you very much for joining us for our second series with Flight on 12J investments on the 15th. And for everybody else, I'd just like to say, stay safe and successful investing. And this is Neil Peterson of Real Estate Investors signing out. Thank you for joining us.